My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just entertain, but try to explain what the heck's going on. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. You know why you need to stay diversified? Because of darn days like today, where the Dow advanced 244 points, closing above 41,000 for the first time ever. But the S&P plunged 1.39%, and the Nasdaq plummeted 2.77%. If you only own the big tech stocks that we talk about so much, the ones that have been leading this market until a week ago, let me tell you something. This day might make you want to give up on the entire asset class. And I bet some, if not many, will do exactly that. Yes, it was that ugly. I got to try to prevent that. Before we get into it, I want to say something about the stock market and what it means to me. It's been 40-odd years since I came down here a block away, and I've always been amazed at how compelling the market can be. I regard it as a gigantic puzzle. I'm always trying to piece things together, figure out if a stock might be a buy or sell. But I know something else. Most people just don't care about individual stocks, would rather just be in some mutual fund rather than be burdened by the difficulty of managing their own portfolio. They want nothing to do with the puzzles. Take, for example, I spent an hour with CNBC Investing Club members and Jeff Marks, where all we did was talk about which stocks win or lose if Trump's the next president. It's a critical issue. Some would say it's driving this entire sector rotation. Of course, the rotation started last Thursday when we finally got a low consumer price index number. When we saw the CPI, most investors figured it was time to buy stocks that really benefit from lower rates. Going to get some rate cuts, mostly home builders and what goes into a home or Home Depot. However, I have to tell you, very few people were prepared for a gigantic, kind of inexplicable rotation out of winners into losers all at once, as if the mega cap tech stocks really hit a wall and they really do poorly in a lower interest rate environment, and they've had their days in the sun and are fini. In reality, they do well regardless of rates, which is precisely why people sold them and frantically shifted into the kind of stocks that can put up explosive earnings growth, but only when rates go lower. On Friday, we had a fairly broad-based rally led by small caps. Again, it wasn't clear why the big cap stocks were out of favor. The small caps just kept running. Then we got the events of the weekend, which led to a new consensus that Trump's extremely likely to win the election. Suddenly, the mega cap tech winners became huge share donors to the loser stocks that had done nothing for ages. Now, here's where it really gets interesting. The shift from winners to losers mirrored the politics of Trump. He and his running mates see themselves as populists, something that's been out of favor for most of my lifetime. They see many big capitalization companies as enterprises that have sold out America in the name of higher stock prices. They abandoned small towns, USA, closed the factories, laid off the workers, and made their merchandise more cheaply overseas. Some of this rhetoric is, I'm telling you, it's right out of the late 19th century, as though they're channeling William Jennings Bryan, railing against the bankers, crucifying mankind on a cross of gold. How does this translate into stock performance? Well, the big institutional investors want to get right with Trump, right, because they think he's going to win. That means buying the stocks of small to medium-sized businesses that weren't involved in the abandonment of rural America, something you can read about in J.D. Vance's memoir, Hillbilly Elegy, which is not a particularly conservative book, by the way. You know what? If you read it a different way, you would think it's actually a left-wing manifesto of sorts. It also means investors are getting ready for more protectionism. Last night, we learned that Taiwan is being vilified by Trump for stealing a crown jewel of American industry, the semiconductor manufacturing business. It's to the point where he indicated that he might lift a finger if China tries to invade. Holy cow. The narrative fits perfectly with today's action. People are talking about it broadening out, but I think that most did not believe that it's a game over for the big dogs, even if you thought they're part of the problem, not the solution. But that's sure what the sellers... I've got the sellers of the techs in the last half hour. They were like, please, tomorrow something really bad is going to happen. I got to get out now. Get out now. But now let me get back to where I started, okay? As much as I love to tell you that all of today's action made sense, including the continual boosting of bank stocks, because people recognize the industry is going to benefit from deregulation in the event of a Trump win, I just can't believe it. In fact, I know it's not true. Days like today don't encourage people to invest in individual stocks, even as we all know that there's been far more wealth created by owning an Apple or an Nvidia or Microsoft or Amazon than an S&P 500 index fund. And by the way, all those stocks were down badly. Why don't people own these fabulous individual stocks over time that have made so many millionaires out of relative paupers? The reason actually is simple. Most people are not diversified. I learned 40 years ago that not all stocks can go up at once. That's why staying concentrated in a handful of stocks is a recipe for disaster and for giving up, especially if they're all part of the same sector. This weekend, while doing some charity work, I heard from a bunch of people who wanted to know why, they were club members, why I stick with such losers like Best Buy or Abbott Labs, instead of just going all in on NVIDIA and Amazon or Apple and Alphabet. I was actually upbraided for buying the stock of Ford for the charitable trust. What a loser. But Ford, Best Buy, and Abbott are the secrets to staying in the game. On days like today, where our position in NVIDIA just torpedoes the charitable trust, I concentrate on the gains we got in Honeywell or Linde so I don't go crazy. If I didn't have them, if I had nothing but, say, NVIDIA and Meta, I'd say, get me out of this stupid casino. I'm done with stocks. I can't take the pain.
The house of pain.
However, because my trust owns a smattering of industrials, retailers, and healthcare, I actually can handle the pain. And it's pain that drives people out of stocks, even as they know they'll probably never get rich if they just park their money in an S&P index fund, the 500, an amalgam of good, bad, and indifferent stocks, where you are resigning yourself to a great deal of mediocrity. I believe in diversification enough that I never mind you owning an index fund, but I want it to be side by side with individual stocks that could potentially make you fortunes. That's why I started the CNBC Investing Club. I know, though, that you won't stick with those stocks if you're undiversified. The pain is just too great on days like today, and then tomorrow you're finished with it. So while you could argue the small, medium-sized businesses have been strong because of lower inflation or the Republican ticket, you could also say some large money managers decided that big tech had gone too far. It was time to sell that and switch to the perennially underperforming Russell 2000. That rush of money into these small-cap stocks sent them to the moon in 5 days' time, and that's what you witness. You know what? I honestly don't care which explanation you prefer. What matters is that you're now getting a chance to ring the register on the winners from this rotation, just a fantastic game, and start making your list of what to buy that's being thrown out. That's what we've been doing. Why do that? Because people like to chase and they hate to buy down. They like momentum and they hate free fall. They're inclined to panic and they toss out great stocks because of fear. They only own stocks like NVIDIA because they were hot. And suddenly, well, you know what? They're not hot anymore. But for you, that could soon be a buying opportunity. Hey, perhaps as early as tomorrow, as we just had our third day of this rotation, and that's when they kind of run out of steam. Too late to buy those stocks for sure. Listen to the bottom line I've got here. For all my years down here, I know that if you self-immolate on days like today because you ignored diversification, put everything in some of the Magnificent Seven, you are doing something wrong. And what can I say? I don't know, because you almost certainly aren't watching this show. Milord in Michigan. Milord.
How you doing, Cramer?
Cramer doing okay. How about you, partner?
I'm good. I just want to say, thank you. We appreciate everything you do for us.
Thank you. These are hard. These are trying days, aren't they?
Thank you. Oh, yeah. It's just like, we got a roughly day to day.
Yeah, we did. But yeah, look, if we only just own United Health and Johnson & Johnson, we'd be geniuses.
Of course. Cramer, I just have a question about McDonald's. McDonald's year to date is 13% down. And as we know, we have their earnings coming soon in 2 weeks. What should we expect from this company, consumer discretionary? And we know,
Okay, I will tell you that when you buy McDonald's when it's down, it has tended to be a great call. Now, and what happens is that like United Health, like PepsiCo, like Coca-Cola, these great brands, people can't get enough of them. So what'll happen is it may not even be that good a quarter, and I still don't think it'll go down. That's how low it's come. It's down 12%. That's kind of where, down 12 to 15% for McDonald's. That's a pretty good price to get. All right, now days like today, where we saw a real bifurcation in the market, prove one of my most important and oft-repeated pieces of market wisdom. You got to stay diversified. Oh, man, money tonight. Close watchers know that we have been looking for brown shoots in this market. One of the earliest signs of them were the transports. So I'm giving you an update on what the sector is telling us about the health of the greater economy. Then I have spotted this lesser-known AI play. I got to put it on your radar screen. You won't want to miss that. And First Horizon reported a quarter this morning that disappointed the street. It's been such a winner. Let's go speak to the CEO. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.